it's really hard because how do you analyze these things?
It seems nearly impossible.
And what if you own, how many stocks does a mutual fund typically hold?
Oh, hundreds.
Hundreds. So how are you ever going to know? Even that money manager, how are they going to know? Even that team of analysts, how are they going to know who's in that boardroom? You know, what decisions they're making to allocate that money, if the reporting's accurate or not, what's happening in the economy, which everybody could. So the level of complexity here is the reason that we don't have a lot of people that are like Ray Dalio or Warren Buffett, which, by the way, Warren is a business buyer, not a stock market investor. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Hey, I don't know if we're going to get through this video. Stova's on one. She's cracking up here. She's having a good time today.
I'm just loving my life.
We're having a lot of questions about, hey, time value of money. If you start investing early, should you not touch it? If the market goes down, should you add more? And so I think this is a question on a lot of people's minds. Why don't you go ahead and ask it?
Okay, this one's coming in from TK. He says, we hear all the time that when the market crashes or takes a significant dip, that it's time to buy as everything is quote unquote on sale. The question is in two parts, and he has a background in a Vanguard account tied to an S&P 500 that he doesn't touch. So number one is, should I put more money in during downtimes? So when the market is dropping. For example, I'd like to capture as much benefit as possible and consider a $25,000 deposit. So,
all right. So we've got Tim Carden here, money nerd. I'm just gonna start with this whole notion of just putting money in every single month. That comes from dollar cost averaging. So dollar cost averaging is basically saying if the market goes up and down, but it's trending upwards, if you just put your money in every month, you're gonna buy at an average share price, essentially. I don't want to be average, so I don't love it. Not my favorite thing to do. It's kind of brain off thinking, just set your money aside and wait. Now, Tim, I think you have some things to say about that.
Well, that's exactly right. Dollar cost averaging. I don't want to invest to be average. I want to invest to be exceptional, right? So The other thing about like trying to time the market,
it's tough.
It's tough. Like you'd have to have some semblance of control over the market. And I haven't reached that level yet in my life where I've got control over the market, right? So,
or just knowing when is the bottom.
Yeah.
Right. I get this notion of wanting to buy when it's on sale. The problem is if you already had money in it and it goes on sale, you just lost, right? On paper. It's only on sale if you haven't been investing and now you're going to buy and you're going to buy towards the bottom and then catch on the rebound. There are some people that can do that, not many.
Yeah. I honestly, off the top of my head, I can think of one client over all the years that actually did that somewhat successfully. When he first got in the market, he was a career guy with IBM for his entire career. He got in the market for the first time, studied it like crazy, tried to identify when the crashes were coming. And every time he felt like a crash was coming, he would move all the way to cash. And then he would just sit and he would wait. And he would wait until it like dropped way down, and then he would like study some more. When does it really going to probably drop out and rebound? And then he would buy back in, and he did that throughout his entire career, and he did better than all of his coworkers.
Well, still, but this is why that's complicated. So the first thing we're dealing with is consumer confidence. Mm-hmm. So if people get a lack of confidence in the market, they might move to bonds, or they might move to cash, or they might stop funding if it gets bad enough. And that fuel actually drives the market up sometimes, and liquidating that in masses could create a downturn, right? Change in interest rates, the Fed could cut. That could impact the stock market, right? We could have poor earnings reports for corporations. We could find out that there were inflated earnings reports that get caught, and because of that level of, I'll call it almost like embezzlement, but exaggeration of what's going on, then people start to lose confidence. So there's just so many factors that are going on in the economy from a global standpoint, from having some virus that starts to impact it, to having, consumer debt and default start to impact it, to people like the major institutions not wanting to buy at the moment because it's not a good deal for them, to the options people saying we're going to short the market because we think it's going to go down and creating downward pressure. And so if any of that sounds confusing, it's because it's pretty easy to have that become confusing. And to really analyze this and to know when to be in and when to be out is a very difficult thing.
Exactly.
So, if you could time it, buy when it's down. But you hopefully are like the client you talked about and you're completely in cash that whole time and not, going down on your main amount of money.
Yep.
That's frustrating.
And he even admitted it didn't work out for him perfectly throughout his career, right? There were times he guessed wrong, and political unrest. I mean, there's, like Garrett mentioned, there's so many things that can happen that influence the market that are so far outside of our control. No one really saw the coronavirus doing what it's done to us. So how would you know?
Yeah. I took econometrics when I was in college. And so one of my kind of the thesis I worked on was really about market predictions, and specifically variable universal life and the chance that it was going to work out, because I went to school in the late 90s, right? But then I started to look past the, earlier than the 90s and look at volatility factors. And I discovered pretty quickly that through something called the Monte Carlo simulation, looking at a number of different pieces and then just looking at how many variables are there. The first several tests I ran, I couldn't create something statistically relevant because of the number of variables that could impact the market. So I didn't have some special algorithm. I didn't have some special way to predict what's going on. And at the same time, I was in a class, Investments 2. I don't know what the subtitle was, but we had $50,000 each to invest that the professor actually put up. So you had really 50 grand, real money. So if you didn't trade by the time the market closed or there was an issue with the internet or any of that kind of stuff, you stayed in cash. And so we did okay. Back then we were buying Amazon when Amazon was just an online bookstore, but we didn't do so well on First Security. It was a bank in Utah that Wells Fargo was buying. And we thought that merger would boost the price, but in the due diligence phase, they found there were some things that were not what they thought when they were buying. And so, it's really hard because how do you analyze these things?
It seems nearly impossible.
And what if you own, how many stocks does a mutual fund typically hold?
Oh, hundreds.
Hundreds. So how are you ever going to know? Even that money manager, how are they going to know? Even that team of analysts, how are they going to know who's in that boardroom? What decisions they're making to allocate that money, if the reporting's accurate or not, what's happening in the economy, which everybody could. So the level of complexity here is the reason that we don't have a lot of people that are like Ray Dalio or Warren Buffett, which, by the way, Warren is a business buyer, not a stock market investor. So I think that it's just too complicated to give much of a stamp of approval to say, yeah, buy when it's low, because how do you know when it's low?
Yeah.
Any other piece to the question?
Well, part 2 says, because I don't and I have not touched my current funds in Vanguard, how does the mechanics of it work when my portfolio drops and then gets restored while riding the ups and downs of the market? Can you illustrate it for me?
Well, the good news is we had Tim Garden on and we filmed the video, and it's a little bit longer, but we went through a 15-day period of time with tons of volatility and showed what actually happens. So go ahead and click the link and watch it, and we'll see you there.